You know, trying to figure out the economy can feel a lot like trying to predict the weather. Is it going to be sunny skies ahead, or are there some big storms brewing on the horizon? Well, today we're going to be the economic meteorologists. We're going to break down the forecast for 2026 and really dig into the one question that seems to be on everybody's mind.
And that's the big one, right? Is an economic storm, a recession, actually coming? It's a question that can cause a ton of anxiety. Doesn't matter if you're a seasoned pro in the stock market or just kind of starting to pay attention to all this stuff. So let's see what the experts are saying, and we'll start with the good news.
All right, let's get into it. The general consensus, the main forecast from most economists right now, is actually for sunny skies. They think the economy is going to keep growing through 2026, not shrink. But why? Why are they so optimistic? Well, it really boils down to three pretty powerful forces pushing the economy forward. First up, there's this huge wave of investment in artificial intelligence, which is helping companies get way more productive. Then you've got government policies like tax cuts, which basically put more cash into the system for people and businesses to spend. And finally, almost everyone expects the Federal Reserve to start cutting interest rates, making it cheaper to borrow money, which, really fuels a lot more economic activity.
So, when you add all that up, what does it actually look like as a number? Well, most experts are putting the chance of a recession in 2026 somewhere in that 20 to 40% range. Now, here's what's so important about that. It means a recession is not the most likely thing to happen. The base case, the main prediction, is for continued growth. But of course, no weather report is ever 100% sunshine, right? Even with a positive forecast, there are always some potential storm clouds on the horizon that we absolutely need to keep an eye on. So let's switch gears and look at what some of the biggest warning signs are. Okay, the biggest, most talked about storm cloud is this thing called the inverted yield curve. I know, it sounds super technical and complicated, but just think of it as a backwards money sign. It has been an unbelievably reliable predictor of recessions. It basically means that big money investors are so worried about the near future, they're demanding to get paid more for short-term risk than for long-term risk, which is the exact opposite of how things are supposed to work. Let's just quickly break this down. Normally, you get paid more interest for lending your money for a longer period of time. That's a sign of confidence in the future. But with an inverted curve, the market is literally paying you more for a short-term loan than a long-term one. It's the market's way of screaming that it's nervous about what's coming just around the corner. It's like a giant flashing warning light on the economy's dashboard.
And it's not just the yield curve. Forecasters are watching a few other things really closely. We're seeing job growth start to slow down, and the prices for everyday things are still stubbornly high. On top of that, a lot of people, especially in lower-income households, are really struggling with high levels of debt. And finally, there's a tool called the Leading Economic Index. It's been pointing downwards for a while now, and historically, that's another big red flag.
So, okay, with all these potential clouds hanging around, it's totally natural to feel a bit worried. But one of the best ways to deal with that anxiety is to get some perspective. So let's take a look at history to understand what an economic storm might actually feel like if one does show up.
This is the key question, isn't it? When we hear that word recession, our minds often jump to this idea of a long, painful, devastating event. But what does the actual data say about how long these things typically stick around?
The answer might actually surprise you. If you look at all the recessions since World War II, the average one in the U.S. has lasted just 11 months. Yep, less than a year. Now, any downturn is painful, for sure, but this shows that they are historically temporary, not some permanent new reality. And sometimes they can be way shorter. I mean, the most recent recession we had, back in 2020, was the shortest in American history. It only lasted 2 months. It just goes to show that not all economic storms are these giant Category 5 hurricanes. Some are just quick-moving thunderstorms that pass right on through.
All right, we've looked at the sunny forecast, we've examined the clouds, and we've even checked the history books. So now it's time to kind of pack our financial umbrella and sum up the key takeaways from this whole forecast.
So here's what it all comes down to. First, the main outlook for 2026 is pretty positive. A recession is not what most people expect. Second, you can't just ignore those warning signs. There are real risks out there that could absolutely change the forecast. And third, if a storm does hit, just remember that history shows us these things are temporary. They do end.
And if you want just one sentence to take away from all of this quote really sums it up perfectly. The general forecast is mostly sunny with some clouds, but the experts just aren't predicting a big bad storm for 2026.
So, now you have the economic weather report. The final thought I want to leave you with is this. Knowing the forecast is one thing, but being prepared is something else entirely. It really all leads to the one question you should be asking yourself. Is your financial plan, is your portfolio ready to handle any kind of weather, come rain or shine?